But let's just go ahead and get started. Today, we're going to talk about the top 10 FAQs that every realtor and loan officer needs to know. This is very important because this is something that keeps popping up from time to time. And, here at Realtor Mortgage Bank, I personally think we run the best mortgage operation anywhere with the most knowledgeable people. But we do have issues from time to time that have more to do with the business being brought in the door than what happens to it once it comes in the door. And so we want to make sure that we always control the expectations of our clients. And the best way to do that is by training our loan officers to catch things before they even become in as actual loan files themselves. It starts with the lead. Everything we do starts and is considered a lead. And once we go ahead and process the lead and determine that it can be converted to a loan, that's when it really becomes a loan. Unfortunately, too many times we refer to leads as loans, that you have a loan on file when it's not a loan on file yet. It's not in process. We want to make sure that we understand the difference between all of those things as well. We're also going to talk about the FAQs, and I'm going to pause throughout the FAQs to explain to you some real life scenarios that we are going through right now that are clogging up the system to a certain degree that really shouldn't be there. We leave a lot in the hands of our MLOs. And that's why we have our training program, because in the beginning, we find that if junk comes in, junk comes out. And I'm not afraid of junk because we can filter it out, but it slows the process of everybody that's eventually going to spend time with something that will never close. And that's just the reality. Now, before we get started, I want to stress, who we are and who we are not as a company. Realtor Mortgage Bank, or RMB, as it stands for right now, we focus primarily on loans that I consider doable loans that most people know are doables. What we are not is we are not miracle workers. We are not the type of company, and we shouldn't be the type of company that focuses on loans that are iffy, or loans that deep down inside of you, is probably not going to fly, but yet you still submit it because you're going to light a candle to it and hope that it somehow makes it. We're not that company. So I want to make sure, and I want to stress that. Red and I had a conversation last week with somebody. I'm not going to mention what state, but it doesn't really matter. And this person was hell-bent on just bringing in loans that they had no social security number. They all had very, below what I would call even a low FICO. And I kept asking him, why do you focus on that? Why do you bring that in versus just looking for something that is more viable, if you would? And the reason that you're working with those people, just so you know, is because other people won't work with them. And so we are not a subprime lending type of company. We do have Alt-A, what we used to call the Alt-A business, but because of the pandemic, a lot of our stuff, bank statement programs, they're suspended right now for everybody. So if you know deep down inside of you that this is not going to be a file that's probably going to make it through, get with Rhett, if not with me, but ideally with Rhett, and let him look at it and tell you point blank whether this is going to eventually close or not before we convert it into a file, and it kind of clogs up the pipeline. And I say that with a lot of love because we are not a subprime lending company. I mean, it's a very tough world in that world for any company. And so there's so much good paper out there that, nobody really wants to buy that right now. So let's just go ahead and get started with this as we get going. How soon after a foreclosure can a person apply for a mortgage? Who can tell me the answer? Real quick, guys, we got to move through this quick.
3 years.
3 years.
3 years. 3 years.
I think it depends on how the lender, the previous lender, reports it on the credit report.
And we're talking about a straight foreclosure. When you pull up somebody, just a straight foreclosure. It's 3 years if it's FHA. Fannie Mae is 7 years or 3 years with extenuating circumstances. And you're going to see that a lot. Extenuating circumstances might relate to what you were just talking about, that if it's something that brings a serious tear to somebody's eyes or somehow makes it better, if you would, under the circumstances, it could be 3. But Fannie Mae technically is 7 years as well. How soon after a short sale? And we don't see these a lot like we were seeing them just a few short years ago, but our business is the ultimate cyclical type of business. I'll tell you that right now. And man, I can't believe what people are paying or what for homes nowadays everywhere. There were times that we would say, just go out of state and you'll live happily ever after with a very low mortgage. Man, it's high everywhere. So I'm not saying it's happening again, but more than likely it will. How soon after a short sale can a person apply for a mortgage? Anybody?
3 years.
One person, 3 years. Okay. FHA, 3 years if they were late. There's no waiting period if they were never late. So one of the questions we always want to ask people is, were you late on that short sale? Because there were people that were late and running a short sale at the same time while postponing the sale of their home all at the same time. So we got to find out the details. But yes, congratulations. Fannie Mae, 4 years or 2 years if they have those extenuating circumstances I was mentioning earlier as well. How soon after a bankruptcy can a person apply for a mortgage?
3 years.
I'm gonna go with that.
Chapter 7, Chapter 11.
Okay. FHA, 2 years. If it's FHA. Fannie Mae, 4 years, or again, 2 years with extenuating circumstances. We're seeing an uptick in things like what I'm sharing with you right now for a lot of different reasons, not just the pandemic, but also the extremely high, and I do mean extremely high prices and values out of the homes. I just saw somebody, I'm not going to get into it, but somebody just bought a home for $800,000, a blue collar worker that I'm looking at him and I'm saying, man, this is going to be tough because I know exactly how much this person makes. And right at the end, they couldn't even almost make the closing because of the money they had to bring to the table. And I'm saying, man, this is just not good. Here we go again, where they needed a lot of help just to close the deal, let alone maintain that property and everything that goes with it. It's just an incredible thing that's coming full circle again, if you would. So you're going to have to know this all over again. How soon after?
Hey, Javier, can I ask you a question? On the short sale, how is it that somebody can be in a short sale and never miss a payment?
Well, then if they've never missed a payment, then it's just basically a short sale. And the question is, are we talking about FHA or are we talking about Fannie Mae? And the overlays are, for the most part, the same. But my recommendation is always just to talk with Red or Rosa, who's the actual underwriter, because these do change from time to time. And it depends on how or what they're looking to do. Now, obviously, as you know, there's a lot of things that go with it. Sometimes it's not the foreclosure itself, or it's not the home that they short sell or the short sell. Sometimes people were late on their car payments as well, their credit cards, and other things add up to the point that now it doesn't become a thing about the home, but rather about the overall credit history and the overlays that the investors are going to put on them as well. So my recommendation to everybody, before you do anything, before you even take an application, is to just talk to an underwriter like Rosa. And that's one of the huge advantages we have here at Radiant Mortgage Bank, that you can talk to an underwriter, Rosa, who is beyond an underwriter. You guys know that, 7 days a week. I mean, if it's a legitimate question, she very graciously makes herself available. And if she doesn't talk to you on that same day, she'll call you back. I guarantee you that, to be able to do just that. So very important. And everybody has Rhett's number, and Rosa, get in contact with Rhett, he'll put you with Rosa. So I don't want to get into specifics that are her side of the house. How soon after a home is listed for sale can a person apply for a mortgage refi? So I'm selling my home. I decide, you know what, I'm not going to sell. I'm just going to refi. Can I do that? And if so,
6 months.
6
Yeah,
months?
6 months.
6 months. Yep.
If it's FHA, 6 months. If it's Fannie Mae, immediately. And so that's important to know, because if they were selling, they probably were going to cash out some equity. And so therefore, they might not have to go FHA. They could just go Fannie Mae. And so the moment that it's taken off of the actual MLS, they qualify for that. Otherwise, if it's FHA, then you're right. They're going to have to wait the full 6 months. How soon after a late mortgage payment can a person apply for a refi?
One year.
1 year.
1 year. And the answer is it depends. It depends on what we are talking about. It depends on several factors, but as a rule of thumb, 1 year is good. If it's Fannie Mae, it's different. So I know you're getting tired of this, but the answer is going to be just check with Rosa to make sure that that happens to be the case. And so there's a lot of different things that come into play that are outside of my scope. So I'm not going to touch that. But what I would tell, if in doubt, give Rosa a call. She will help you out, but you need to make sure you know that. And the reason I'm bringing this up, just so you know, we are in a rising rates environment, as you know, and every half a point, God forbid, every eighth of a point that goes up, we lose a segment of the market that qualified for a refi just simply with the ability to meet the minimum requirements to save them money for them to qualify. And so therefore, it's important to know that a lot of people are getting left behind right now. And I hate to say this, but too many people sometimes are just simply refinancing, not to save money, but to loosen up money here that they can spend over there. And they're finding themselves in the same position as they were when rates were high. And so whether it be a refi, whether it be a foreclosure, they're going to come back eventually. And we're starting to see an uptick in some of these things because of the forbearances are being pulled away now. And now that the pandemic is near the tail end, a lot of the things that were keeping people in their homes are going to change the market. So when you combine more inventory with rising rates, you know, it doesn't take an Einstein to figure out what comes after that. And so therefore, we are in the middle of, and still are in the seller's market, but it goes from seller to buyer to seller to buyer. And all of you have been in the market as long, if not longer than me, to know that. And so it's not the end of the world. As part of the reason that I love working on the mortgage side is because of the fact that regardless of where rates are, people need to buy homes, people get divorced, people get married, people form families, people need more room. And I remember I got my first mortgage that I got, and I got a very good deal. This is back in 1995. And I was able to get this killer interest rate because I was a VA. I was a veteran, and I went with the VA, and nobody else could touch it. And it was 8.5%, 8.5%. And people were asking me, how did you do it? How did you get it so low? And the answer is, well, it's a VA loan. So I was able to qualify for a low interest rate of 8.5%. And it was on a condo, a townhome to be more precise. And the townhome that was across the street, well, not across the street, but across the pool, you know, from where we were, they let theirs go. And part of the reason they let theirs go is that they had paid $185,000, and here I am paying $85,000. They had just paid that 4 years earlier, and they just couldn't stand it, and people walked away. So you've all been around to know that that happens, but you've all been around long enough to know that when it comes to mortgages, they are the tail that wags the real estate dog. Mortgages are part of the industry, which is why I love it. The only difference is, are you part of the loan officers that understand that and monetize mortgages? I mean, I've been in the, like I said, 8.5% market. I've been in the 2.5% markets, and everything in between. And here we are, still closing deals. So it's not one of those things that just because rates are low, we're going to do good. I actually like it more when they're a little higher, personally, just because it gets rid of all the riffraff. Right now, we're back to where we were before. 1 in 7 Californians had a real estate license. Right now, it's like 1 in 6 has a real estate license. And then when the market drops, we go back down to 1 in 30, which is where I like it a little bit more, to be honest with you, than where it is right now. And so the only difference is technology. That's never going to go away. So I'll talk about that here in just a little bit. How soon after an FHA mortgage records can a person apply for a Streamline Refi? Anybody. You help them buy a home. They use FHA, right? And you want to refund if they qualify.
3 months.
3 months.
3 months. 3 months.
6 months.
6 months. And the best answer one can give for this example is in days, actually. But the answer is 6 payments. 6 payments. Most people say, well, duh, that's 6 months. Not necessarily, but you want to go with the 6 payments, or even better, technically, it has to be 210 days. That's what you want to do. And this is also something we have to be very careful, because as you know, here at Radiant Mortgage Bank, we do have chargebacks, and that's something you don't want to trigger, where because of the fact that you refied, they're going to get charged back money that is owed because it was not there long enough. And so you want to make sure and this is part of the way we secure or look out for our clients, that if you really do screw them by giving them too high of a rate, they go down the street and get a refi at a lower rate. Technically, they shouldn't qualify, because we're not going to meet that minimum benefit, that tangible benefit, as it's defined, NTB. There has to be a net tangible benefit for another competitor, another bank, to refinance them. And if they don't qualify, guess what? That means that there's no tangible benefit. There's no net tangible benefit. Now, everybody talks about half a point, and it's not just the point part, even though that's a very good rule of thumb. You don't want to leave them where they can lower it half a point, but there's more to it. But if the net tangible benefit is not met, then that protects you, that protects the client primarily as well. How long of documented work history does a person need to apply for a loan?
2 years.
2 years.
2 years.
2 years, 2 years. Fannie Mae, FHA and Fannie Mae are both 2 years. And that's very, very good. Congratulations. We're doing very, very good today. And how is income determined for self-employed individuals? Because that's something that's growing, and it's going to, because of the pandemic, a lot of people started their own gigs at home. A lot of people that were doing side gigs as a business part-time are now doing it full-time. And this is we actually had one individual this past week that wasn't very happy because of this. But remember, these are not our rules. So somebody doesn't like it. Well, I mean, they just don't like it. There's nothing we can do about it. How is income determined for self-employed individuals? So if I'm telling you, hey, I'm self-employed, what is it?
Schedule C.
Okay.
Schedule C.
2 years business taxes.
Business taxes. Okay. Anybody else? And in this example, the person qualifying is the natural person, correct? Meaning the client, unless they're buying it for the company money or something like that. But we don't do those types of loans. So we're going to need proof of income. And this is where it bites us all in the butt. Nobody wants to pay taxes, so we declare the least possible. But when it comes time to actually qualify, we go off your tax returns. So we have
The
to
net,
go off,
right?
what is it?
Isn't it the net?
There we go. We're getting there. Okay,
Tax
yeah.
return?
And so this is an old, forget the 2019, but it's basically Schedule C. For 2019, it was Schedule C line 31. And it hasn't changed a whole lot, but we're going to go off that, the net profit or the net loss. Now, if it's a net loss, obviously they don't qualify. So we're going to go off the net profit. And just remember that somebody cannot, when it comes to any mortgage, they cannot take credit for both income and for a write-off at the same time. We all write off stuff that maybe we're a little liberal on. I can't go up and say, look, listen, last year I declared 50,000, but in reality I made 150,000. We pull up our taxes and it shows that I wrote off 100,000. You cannot get credit as income and keep the actual write-off at the same time. And that's the portion that writes everybody. It bites everybody in the butt, because that's when people say, look, but you know very well what I do and how I do it. Oh, I know that. But it's not me, it's the investors that are protecting themselves. And also I'm protecting myself, because if there's fraud involved and I perpetrate it or I go along with it, I'm going to get in as much trouble. And it's just simply not worth it. And this is for 2019. Again, you would obviously use 2020 and 2021. But when we go in there, this is for the 2019 form. We would literally go to line 31 of Schedule C and see it. Right there, as you can see, the net profit or loss. And whatever number is there is the one that's going to be considered their income. We're not going to go off the top line. Nobody's going to go off the top line, even if it shows $1 million, but yet line 31 shows 100,000. We're going to go with line 31. Does that make sense? This is probably the biggest challenge when it comes for a realtor who also does loans or a loan officer to really, really want to sell a home to this person, because they really know that they make a ton of money and they really know that it's just a wash and they really know that they really have the money. It doesn't matter. We are a legitimate company. If line 31 says 50,000, then we go off that. If it says $1 million, we go off that. Whatever's in that line is what we have to go with, and there's no way around it whatsoever. And so therefore, it's very important for you to understand that. And, this past week, we were dealing with a few people that doing the old wink, wink, nod, nod, really why they write it off. I don't care. I get it. I'm with you. It's not that, we're in the business of lending money. So of course we want to do it. But if the paperwork doesn't support what the person is telling us, there's only one thing left to do, which is to lie, or we don't want to do that. I'm not going to do that. And if you do that and get caught, there's this place called Club Fed where you go on vacation for a couple of years. And I don't want to go to Club Fed. And one thing I will tell you over and over, the federal government loves, listen to me, they love making examples of people and hold up somebody and say, see, this is why we're here. This is why we're taxing you to death, because we're protecting you from people like this person. And they hold your picture up and say, this is the person that causes the crash and causes this. And they're right. I'm not going to Club Fed. If you want to go to Club Fed, go by yourself or go with somebody else, but don't invite me. And I'm not going to put you in a position to risk your license or any of that stuff for a quick buck, because I'm not going to do it. But if they qualify, they do. If they don't, they don't. Rhett actually made a recommendation. This is from a person that we were looking, or was looking to come on board, I should say, and this week with us. And at the end of the conversation, Rhett just point blank said, this is, our company is probably not the one that you want to be with. And the person just kind of went away, and it was very true. You sometimes have to do that. I'm in the business of recruiting people, loan officers, closing business, but in bringing this person to Rhett just to get a second opinion, Rhett just point blank said, look, we're probably not your company. I'll be honest with you. We're not going to do it. We're just not for you. And I was fine with it because, I don't want Brett to risk his license or his livelihood or vice versa. And so, he was right. This was not right for that person. And that person simply moved on. And so, like I said, just remember, Club Fed is not good. You don't want to go to Club Fed. And they will put you in there just to make you an example. What cost can an MLO credit to a borrower through escrow? This is very interesting because both as a realtor, now we're talking as a MLO. So what cost can you credit somebody?
Credit report.
Credit report. And we want to be careful, right? Because what we're looking for is what kind of violation here? What we want to avoid. RESPA. Absolutely. You don't want to do that because that will land you in Club Fed as well. So no RESPA violations. So what cost? And it's much different, by the way, than a realtor on the real estate side. And you might be both. So you got to be careful that you credit them on the MLO side, not the real estate side, not the realtor side. So what cost can an MLO credit to a borrower through escrow? At the closing of escrow is usually what we call it. And this one's pretty easy.
Appraisal.
What is it?
Appraisal.
Appraisal. Okay. Now this one is pretty easy because it's also very powerful. This is where we can go ahead and help make a deal close that couldn't be closed if you structured it right with the yield spread premium, rebate, or whatever you want to call it. And the answer is you can credit them both recurring and non-recurring costs except for a down payment. So what that means is that you can you can go ahead and credit them for anything except what?
Down payment.
Down payment. So can you pay their credit report check fee? Yes. How about their inspection fee? Yes. How about their, you name it. On the mortgage side as an MLO, and here's the best part. It's also the cleanest way to do it because you're not going to give them money that you're going to get taxed for. That's the best part. It's a credit versus me saying, here, I want to give it. So in other words, Radiant pays me $10,000 and I get taxed on $10,000, but then I turn around and I give $5,000 to the person here that's actually doing this through escrow. Let's just say it's the buyer. Well, there's no tax consequences because I never got the money. So I might have $10,000 coming, and I could say credit $5,000 towards recurring and non-recurring. That will be their escrow. That will be their title insurance. That'll be whatever it covers. Give it to them. But I'm only going to see on my 1099 or W-2, depending on how it's structured, the $5,000 I actually get, which is pretty cool. And this is why it's so important for you not to be one of these people that's always focused on the lowest rate possible, because you don't want to do that. I get people that I give them a choice. I can give you a 2% or I can give you a 2.75, but with the 2.75, I'm going to pay $5,000 of cost that you don't have to bring to the table. And by the way, it's only a $35 difference in mortgage payment. That's when they usually say, give me the 2 points. Do you even have a 3? Yeah, we have to. And so the point of this is it's the monthly payment is minimal to them, especially when the rates are so low. But the bring to the table, I told you we had it wasn't my case, but I had somebody who bought a property and they couldn't even come up with the money at the end to pay for all the closing costs. And the only way that they got saved was through a credit like the one that I'm describing to that I never would have given them. It wasn't my case, but you could, and you could be a hero. And so, like I said, you can go ahead and credit both recurring and non-recurring. What's recurring, by the way? Anybody?
I don't know.
Taxes.
Okay, taxes go on and on and on, so that's recurring. How about non-recurring?
Appraisal.
Yeah, appraisal, because they only do it one time, yes.
Escrow fees.
Escrow, what else?
Title.
Title, absolutely. And so what I'm getting at is that you can see, because remember, what you have to make sure you do as a real estate agent is always let them know that when they refi a home with us, what's really nice is they can just take all these costs and put them into the loan. When they purchase it, they have to bring all closing costs to the table in cash. They have to bring it to the table. And that's a big problem. If the realtor, loan officer, or somebody didn't tell them that, they might say I have 3.5% down payment, but when you tell them they're going to need about another point and a half of closing costs, that could be a deal breaker. And I see it happen all too often. So you want to make sure you understand that. Now, having said that, that's why you don't want to always promise the bare bones type of rate that leaves you no rebate or no room to negotiate or help them out with if you need be and make the deal. Now, I'd rather give them something in closing costs and still get paid versus give them nothing because I don't have anything to give them and close with no or lose the deal and never get paid anything at all. So you want to make sure you definitely do that. Are all non-occupying borrowers allowed on a home purchase? In other words, I'm buying a home and I'm getting my brother who doesn't live here. He's not going to live in the house, but can he help me out? Are non-occupying borrowers allowed on a home purchase?
Yes.
Okay. Yes. Anybody else?
Yes. Yes.
Yes. Everybody. Yes. Is that what it is? Okay. Not too sure. All right. Well, the answer is, if it's FHA, it must be a family member, or the loan to value cannot be greater than 85%, meaning they have to bring 15% to the table. So if it's not a family member, then the answer is no. And so the answer is depends. It's for FHA, must be a family member or loan to value no greater than 85%. And for Fannie Mae, it's allowed with no restrictions. The only restrictions that we have to keep in mind is that person might have a home or a mortgage assigned to them already, which might make it harder, if not impossible. We have to use the loan to value, and we have to do everything. We have to qualify them as well. So they might not qualify because they already have a lot of debt in the form of a mortgage or whatever the case might be. But the answer is that it depends. But if you're going with FHA, which is probably what we do the most, it must be a family member. Or if it's not a family member, the loan to value cannot be greater than 85%. Are we good with that one?
Yes.
Cool. And the reason that I bring this up is because, like I said, the individual that almost came on board with us, a loan officer this week, he brought it's like this person was looking for the nightmare scenarios every time. He goes, well, the people that I work with have bad credit. Okay, that's a red flag right there. And on top of that, they don't have all the down payment. That's another red flag. So you got somebody with bad credit, with no down payment, that wants down payment assistance, and works for themselves on top of that. Most of them don't have a regular job. I mean, it's like, dude, if that really is who you're going after or who you have, yes, that's who I have. I mean, maybe you come across people that have a regular job or have decent credit. They're going to have be self-employed or have assets or have money. No. Then, based on all that you're telling us, if that's really who you have, we're not your company, because we're not a subprime company. And I actually ended up just moving away and deciding not to sponsor this person because it wasn't worth the risk, if you would, based on what the information we had at hand. And the more you know about the things that I'm sharing with you right now, the easier it's going to be for you to be able to, when I'm talking to somebody, what I love about being in real estate and mortgages is that we deal with the American dream of home ownership. But the reality is that most people will not qualify. By default, they won't qualify. So when I talk to somebody, I'm not going to try to force this round peg or a square peg into a round circle, knowing that until I know they're probably renters for a reason, number one. But when I start to talk about their credit, and when I ask people about their credit and they all tell me that it's good, and I say that we have to pull the tri-merge, which means we're going to pull all three major credit bureaus, and then we're going to look at the middle one. We're going to go off the middle one. I'm just laying down the foundation to be able to go ahead and pull their credit. And if I can't pull their credit, I'm telling you right now, I'm just simply not going to move too far down the road with this one. And then once we start to talk about assets, one thing I'm going to ask for is I'm going to go ahead and verify everything via bank statements, because it might be in the name of somebody else. It might be along with somebody else, or whatever the case might be. And so the point that I'm making is that you should be excited when you have a potential file, but that's just the first step. You should start to position yourself, if you would, to go ahead and grab everything that you need so you can submit a complete file. All too many times we pull credit, we take a 1003, we enter it into lending QB, and we're off to the races. When we haven't pulled the proof of funds yet, we don't know where the money's at. We don't know who has the money. It might be it's very common that the name is under somebody else's checking account or savings account. That's not going to cut it. There might be adjustments we need to make, put it into your account, or whatever the case might be. That takes time before we pull the trigger. And that happens all too often when it comes to when it comes to pricing of the loan. We don't lock it in for 60 days, as you know. And so when somebody says that they have to go do something that requires a new bank statement that's going to take place not until next month, your loan's going to expire. You're going to be in trouble. And so you want to make sure that you're flexible. Yes, you want to be excited, but at the same time, you have to be a prudent loan officer. I know that there are things that are required, not to punish you, not to make life harder on your borrowers, but because of what the investors require. And it's one of those type of things that in the beginning, that's why I stress, make sure you work with somebody, especially if you're newer in training, and that you follow the lead of your trainer to not get your hopes up and not close the file and not open escrow and have the escrow fall apart, all of it unnecessarily because we didn't do our part in the beginning. I don't know if Rhett's on board. I'm not sorry to come in. Rhett, are you there? I don't think he's going to be. You here?
He contacted me and said he won't be able to make it. He's doing a list.
He didn't contact me. Okay, perfect. That's what I wanted to make sure. Are there any questions about anybody regarding anything? I mean, I will tell you that the environment that is taking place with interest rates right now, I don't follow rates. And the reason I don't follow rates is because I'm not one of those low rate type of people. You've heard me preach this a long time ago. People are always buying, people are always selling, people are always refinancing because most of them are definitely compelled to do so due to circumstances beyond their control. Yes, there are people following that low interest rate, but for most of those people, the boat is leaving. They either get on it ASAP or they're simply not going to be able to meet their net tangible benefit here real soon, if not already. And so don't worry about that. There's tons and tons of business that as long as you are a profitable, meaning that you're making money as a loan officer and or as a realtor, you're going to be in a perfect position because for me, I like mid to high rates environments better than low rates because everybody and their mother comes out of the woodwork to do quote loans. And it just kind of murkies the water a little bit when there's not that much value. Once rates go below 3%, our borrowers are not going to see that big of a difference from a 3% to a 2.75 to a 2.5. And the lower the rate goes, the lower the benefit for them as well. And so don't get yourself all caught up if you hear that rates are going up or that they have gone up. It's not the end of the world. On the contrary, as far as I'm concerned, I would much rather work in a higher rate environment than a lower rate environment just because the people that I work with are doing what they're doing because they have to. They want to buy that home. They want to upgrade. They want to downgrade or whatever the case might be. So don't think for a second that somehow you have missed the boat or that somehow it's too late or that the boom is over. No, we are far from any boom being over. We're at historic low rates. So when somebody asks you, what are rates today? Well, today they're at historic low. That's what they are. They're historically low. And so therefore, it's very quick to assess whether or not they meet their net tangible benefit. If it relates to buying a home, it always makes sense to buy a home versus rent. There's just no other answer to give to that. And so I just hope that nobody here gets discouraged. And if you haven't been submitting business, to get on it. Right now, people are actually calling us now because they know rates are starting to inch up. It would be misinformation for me to tell people that, oh, don't worry, give it a month or two because they're probably going to be lower than they are right now. Maybe they will. Realistically, they probably won't. But I will tell you that people are looking like never before because they know that if the ship hasn't set sail, it definitely has started its engines and it's about to get moving shortly, and they don't want to miss out. Any questions, comments, or concerns from anybody about anything before we wrap it up? Anything?
This is great information, Javier. Is it going to be put up on the website?
In about an hour or two, it'll be there.
Nice. Thank you.
Okay.
Awesome.
Perfect. Anybody else? Questions, comments, concerns, anything at all? This is your shot, your chance. I just want to say thank you for all that you do. I challenge you to make this coming spring and summer and fall the best seasons of your business life. And it's all possible because slowly but surely places are opening up. Churches are opening up. Police stations are opening up. You know, I was in Hawaii this past week, and Tuesday at 9 a.m. here, Pacific Standard Time, I had an appointment with the police officer from a roll call I did last year. And I couldn't believe it, but I kept the appointment. 9 a.m. here is 6 a.m. in Hawaii. Thankfully, I was up since 5 in Hawaii. And I was just simply knocking out the appointment with this police officer because to me, you got to strike while the iron is hot. And right now the iron is hot, but it's going to start cooling off a bit. And it's not the end of the world. Like I said, to me, it gets a lot of players off the field. And ultimately, I compete with myself, not with other people. But it definitely keeps the water from being murky too much by people that said that they can do it for less or a lower rate or whatever. Look, if you can find a better deal that benefits you more somewhere else, by all means, go there. but I can guarantee you that if you are looking for something that's more of a lifelong strategic relationship, I'm your guy. And I can help you like I've helped hundreds and hundreds and hundreds of people personally and thousands of people through my teams throughout the years. And you can be one of them or satisfied customers for life. And all we ask is that you're realistic. So don't overpromise things. I was watching a commercial on TV the other day, and they had like a 2.5% interest rate. And then I was telling my wife, wait till the disclosures come in at the end. And sure enough, loan to value of 60% or lower. Who the hell has that? FICO 750 and higher. Not that many people have that I deal with at least. And it just goes on and on and on with all the disclaimers that they have to give at the end and disclosures. And the point of it is that here at Radiant Mortgage Bank, we can be as competitive as we need to get the deal done. But at the same time, don't sell yourself short. Don't be a salesman or a saleswoman. Be more of a strategic advisor for people. They will appreciate that, because if you do that, they will consider you their strategic advisor for life. All right, everybody. I wish everybody a happy Easter or happy Passover, or just, whatever it is you might celebrate. I wish you a great weekend. And most importantly, I just encourage you to please stay safe as we come to the tail end of this pandemic. Don't be a casualty in one way or the other. Be careful, be safe, and have a great weekend. I'll talk to you soon. Okay? Bye-bye.
Thank you, Javier.
Thank you. Bye-bye.